Okay, so let's dive right in with a quote that absolutely jumped off the page for me in the
Oh,
sources.
yeah. What was it?
The CEO of what is, probably the world's most crucial chip maker,
Mm.
he described the current demand levels as, and this is his word, insane.
Right. We're talking about Taiwan Semiconductor Manufacturing Co., ASMM. And that word insane, yeah, that came directly from the CEO, C.C. Wei.
And it's specifically about AI chips.
Exactly, on their last quarterly call. I mean, it just perfectly captures the sheer scale of this AI infrastructure build-out that's happening right now.
It really does. And for anyone trying to understand the actual, pipes and wires that are powering this AI revolution, TSM is. It's the foundation.
It's everything.
So our mission for this deep dive is, I think, pretty simple. We're going to move past the general hype and synthesize the hard data.
The financials, the projection.
Exactly, the valuation metrics, all of it, to really get why the sources are calling this company an excellent buy.
Well, and you have to set the stage first. You have to appreciate the sheer magnitude of this shift in the semiconductor world.
It's not just about phones anymore.
No, not at all. This is all about high-performance computing, HPC, for data centers. That demand it's fundamentally reshaping the whole industry. And TSM isn't just a player. They are the absolute center of it all.
The nexus.
The nexus, yeah. And we'll get into why the numbers suggest the biggest opportunity is, believe it or not, still ahead.
Okay, so let's unpack that momentum. Let's start with what's already happened, because it's very impressive. TSM shares have nearly tripled.
In just the last 5 years, yeah.
A $1,000 investment 5 years ago is worth about $2,800 today. That's a huge return.
It's a massive return. But that historical performance is really just proof of concept, right? It proves their dominance.
So the question is always, where do you go from here?
Exactly. And what's so interesting is that CEO, quote, calling demand insane, it signals something really important for you, the listener.
Yep.
That even after a run like that, the people actually running the business think investors might still be underestimating the growth ahead.
So they see this as a marathon, not a sprint.
Absolutely. The sprint is done. They're gearing up for the long haul.
And this isn't some, speculative future thing. The sources are clear on this. High-performance computing chips are already the majority of TSM's revenue.
Right. They aren't hoping for an AI boom to happen. They're literally manufacturing the engines that are driving it right now.
That's the key, I think. They hold this unique technical position. Their competitive moat, it isn't in designing the chips.
No, that's what their clients do. Nvidia, AMD, Apple.
Right. Their moat is in the manufacturing, making the absolute most powerful, most complex chips in the world.
And that locks them into the highest value, highest growth part of the entire industry.
I want to dig into that moat for a second because it gets glossed over, but it's so critical. What does mastering the bleeding edge of fabrication actually mean in, practical terms?
It means they've perfected manufacturing at a scale that's almost impossible to imagine, the nanometer level. They are the clear leader in producing the latest generation chips using this incredibly complex technology. It's called EUV lithography.
Extreme ultraviolet.
Yes, and it uses this hyper-precise light to etch circuits that are just, say, 3 or 5 nanometers wide.
Which is ridiculously small.
It's about the width of 10 gold atoms. I mean, it's mind-boggling stuff.
Okay, so here's the question then. Why can't competitors just buy the same EUV machines and catch up?
Because it's not just about the machines. That's part of it. But the real secret sauce is in the process, the know-how and the sheer scale they operate at.
The expertise.
The expertise, yeah. Building one of these fabs, as they're called, costs tens of billions of dollars. And it takes years of accumulated knowledge to get the yield rates, the number of good chips you get off a silicon wafer, up to a profitable level.
So the barrier to entry is just astronomical.
It's massive. And it's a barrier that competitors like Samsung and Intel are really struggling to overcome, at least at TSM's scale and efficiency. It's why anyone who needs the absolute best performance has to go to TSM.
That makes the connection between their dominance now and the future projections so much clearer. They basically have a choke point on supply.
That's a good way to put it.
So let's look at those future expectations. Their recent performance was incredibly strong. Third quarter earnings per share jumped 39% year over year.
Yeah, for a company this big, that kind of growth it's almost unheard of.
And that's just the immediate reflection of the AI boom.
That 39% jump, yeah, that's the big AI players just buying up everything they can for their data centers. But the really stunning number, the more insightful one, comes from management's long-term forecast.
You're talking about the AI revenue specifically.
Yes. They expect revenue just from AI chips to grow at a compound annual growth rate, a CAGR of over 40%,
Over 40% through 2029.
through 2029. It's an extraordinary statement of confidence.
So for anyone listening, KGR means that's the average growth rate compounding every single year for the next 5 years.
Exactly. It shows they see this AI boom not as a temporary spike, but as a fundamental, prolonged shift in global computing.
And it seems like Wall Street analysts are basically backing this up. The sources show that even when you factor in the, the more cyclical parts of the business, like smartphones, consumer PCs,
Right. They still expect TSM's overall earnings per share to grow at a really robust 22% annualized rate for the next few years.
which is still fantastic. And it brings us right to the big question. Valuation.
The sticking point.
It always is. If a stock is nearly tripled, you've got to wonder if you missed the boat.
Right. You look at the current price to earnings multiple, the PE, and it's around 30. That can look like a red flag. It's definitely elevated.
It is. But this is where the analysis gives you that aha moment, the idea of growth at a reasonable price.
A PE of 30 might look expensive today, but the sources argue it's deceiving. It doesn't fully account for that future earnings growth we just talked about.
So you have to look at what they're projected to earn tomorrow, not just what they earned yesterday.
Precisely. And when you adjust that PE based on future earnings estimates, specifically looking out to 2026, that multiple drops.
It drops significantly.
It drops all the way down to 23.
Wow. Okay, so the price today is basically discounting the huge earnings growth they expect over the next couple of years.
That's pricing it in, yeah. A PE of 23 for a company growing overall earnings at 22%, with its core AI segment compounding at over 40%.
That starts to look much more reasonable.
Much more. It signals that even after this huge run-up, the price hasn't fully caught up to where the profits are headed.
Let's pivot to strategy then, because projections are one thing, but you have to put your money where your mouth is. What is management actually doing to support this insane demand narrative?
They're committing staggering amounts of capital, CapEx. The sources are very clear on this. They're investing heavily to expand their global manufacturing footprint.
So we're talking about building new fab.
Massive new fabs. The most famous example is the huge investment in Arizona. But they're also expanding aggressively in Japan and constantly upgrading their home facilities in Taiwan.
And we're talking tens of billions of dollars a year.
Annually, yes.
Yeah.
It is a massive, massive bet.
But wait a minute. If they're spending that much, doesn't that risk squeezing their margins in the short term? I mean, that's a huge cash outlay. It sounds risky.
That's an excellent point, and it's a critical part of the analysis. And yes, it absolutely pressures free cash flow and margins in the short term, no question.
So why do it?
Because for TSM, that spending isn't just a cost, it's an insurance policy. They are deliberately choosing to prioritize market share and future capacity over perfect margins today.
They're playing the long game.
They're playing the long game. They're betting that if they don't build this capacity now, their competitors will try to fill the gap and threaten that technical moat we talked about.
So the spending itself is actually a huge bullish signal. It shows they really believe their own projections.
Exactly. They are aligning their actions with their words. They're willing to take a short-term hit to guarantee they capture that long-term 40% AAGR AI revenue stream.
And that really brings it all together then.
It does. When you synthesize it all, the strong earnings, the massive strategic investments, the wide technical moat, and these huge, clear AI tailwinds, the case gets pretty compelling.
And the final assessment from the sources is?
It's unified. Taiwan Semiconductor stock remains an excellent buy for investors seeking to outperform the market.
It makes sense. This company isn't just reacting to AI demand anymore. It feels like they're actually defining the physical limits of the whole sector.
They are the essential link, the foundation that every single major AI company is building its future on.
Okay, so let's just do a quick recap of the key numbers for you to walk away with today. First, that incredible past performance, nearly tripling your investment in 5 years. Second, the immediate health signal, that massive 39% jump in quarterly earnings. And maybe most important of all, that forward-looking projection.
The big one. That 40+% compound annual growth rate for their AI revenue all the way through 2029.
Right. These numbers just underscore TSM's critical role. They make the chips that build the future.
They do, but the deep dive shouldn't just end with the stock ticker, right? If TSM is really investing to hit that 40% growth rate, that implies a gargantuan shift in our global infrastructure that goes way beyond just chips.
What do you mean?
Well, the sources suggest the growth is undervalued because people can't really grasp the scale required. So here's the final thought for you to chew on. Given that ambitious 40% cake share target, what other physical infrastructure has to fundamentally change to support that demand? Think about the colossal requirements, not just for software, but for power grids, for specialized liquid cooling, for global networking.
All the stuff that has to exist for those chips to actually work at that scale.
Exactly. What has to change in the physical world over the next 5 years for TSM to even be able to sell that many powerful chips? That's the true scale of the change they're betting on.